Good morning and welcome to another in our series of Pulling Back the Curtain webinars. And today we're going to talk about mortgages, qualifying, closing costs, a lot about closing costs and how we have programs that can save you thousands, maybe tens of thousands of dollars in closing costs if you're looking to buy a house. We're going to talk about some pitfalls also when parents try to help children and co-sign or give them money can create problems for the parents. If they need to go into a nursing home. So, well, we're going to touch on that stuff. And if you've got any questions, just type them into the chat box. We'll try and answer them as we go along. And if we can't get to them all during, we'll answer them after. This should take about 25 minutes. There's about 23 slides to go over. And so I'm going to share my screen with you here. And it should be coming up. Okay, here we go. Pulling Back the Curtain series, all about mortgages or special programs to save buyers thousands of dollars in closing costs. And that's true, thousands of dollars. If you're buying a house, we have programs starting at $200,000 and up, where we're going to show you we can save you up to $5,500 in closing costs. We're also, again, as I mentioned, going to talk about pitfalls when parents try and help children qualify or buy a house, whether it's a house that's on the market or a house that the parent owns. A little bit about me. I've been an attorney for over 30 years. I own a real estate company, my own company, Keith Elliott Real Estate Services, mortgage company, Advocate Mortgage, and I also have done thousands of title policies. I conducted hundreds of closings. I'm a certified financial planner, a registered investment advisor. My mortgage company's closed hundreds of millions of dollars in mortgages over the decades. We do all kinds, conventional, FHA, VA, and we can save you money compared to a retail lender like a bank. The agenda, we're going to talk about types of mortgages, cash required, our programs that save you the closing costs, that reduce the cash required, debt to income ratio, some strategies to help you qualify if you're not qualifying, pitfalls, again, that we discussed, documentation. I think we have a slide on that just goes over the type of paperwork that you have to pull together. It's a lot of paperwork for a mortgage, and then a slide on self-employed issues. They need more documentation than somebody that's an employee. We'll talk a little bit about interest rates and adjustable rate mortgages, and they're not really as risky as some people think, but there are instances where you don't want to use them. But we'll talk about what you have to know if you decide you're going to go down that route. What kind of properties we're talking about? We're talking about strictly residential properties, not commercial properties, just 1 to 4 units, single units, 2, 3, up to 4 units, condos, or properties in a plan with a homeowners association. No commercial properties, no mixed use where there's a business in part of the property, nothing that's under construction, homes that are under construction. That's again, a different kind of an animal, not good or bad, just different. We're not going to talk about construction loans today, just mortgages for homes that are already existing. 3 kinds of mortgages: conventional, FHA, and VA. And so if you're not a veteran, you can't get a VA loan. We'll start from the bottom up. If you were in the military and you get a certificate of eligibility, you could be eligible for a VA loan, but you got to get the certificate of eligibility. And if you have that, you can finance basically 100%, and you can have the seller negotiate with seller. And if the seller agrees, they can pay all the closing costs. So you could actually get into a property with no money. The VA does charge a funding fee, a one-time fee for each mortgage, depending on how many times you've used your eligibility. An FHA loan is good for people that may have lower credit scores. With the hot market, sellers really have not been inclined to accept FHA borrowers requesting FHA mortgages. They're tougher on properties. The FHA's got a thing about peeling paint and cracked windows and things that just annoy sellers. So you can do an FHA loan with 3.5% down. You really don't have to have any of your own money. It can be a gift. You can have the seller pay up to 6% of the sales price. So, if you've got lower credit scores or very little money, it's an option if the seller will accept that. Most mortgages are conventional mortgages. You can do them fixed or adjustable. By the way, you can do fixed or adjustable in FHAs and VAs as well. But if you've got good credit, 740 score or more, and you've got enough money to put down 5%, sellers prefer these. Sellers are allowed to pay up to 3%. If the borrower puts 5% down, 6% of the sales price toward buyer's closing costs. If you put down 10% or more, you can borrow up to 647.2 on a conventional conforming mortgage. So there you got the three kinds: conventional, FHA, and VA. How much money do you need? High level, without getting into a lot of details, you need three things. You need your down payment, closing costs, and prepaids. Down payments, depending on the program, I would figure 5%. Conventionally, you can do 3% under the Home Ready or Home Possible programs with Fannie and Freddie, but that's got income limitations. The standard closing costs, so you have a down payment, down payment 5%, your closing costs, I'd figure 3 to 4% depending on the area. The big factor there, the difference is transfer tax. Transfer tax can be anywhere from 1 to 2.5% for the buyer, and also for the seller, 1 to 2.5% depending on the area you're buying. And then I always tell people figure a year of taxes and 14 months of homeowners insurance, so a year plus 2 months, a month of PMI, and interest from the day you close to the end of the month. And that's just a function of the day you close. So if you close the middle of the month on the 15th, you may pay 15 days of interest. If you close on the last day, you pay 1 day of interest. So down payment, closing costs, prepaids, and sometimes, not usually with a owner-occupied property, but if you have if you're buying a rental investment property, you may need money for reserves, which varies depending on, again, if it's investment property or not. But depending on the approval we get from Fannie Mae, you may need to have a month or two of reserves. A month or two, that means a payment, one or 2 months, to be able to show that you can make 1 or 2 months of payments. Again, I just put some numbers to the ratios here. 5% down on a $200,000 house. If you want hard numbers, for your $10,000 closing costs, estimating 3.5% of $200,000 house, that's 7, and then taxes and insurance, again, estimated for your 7. So if you're buying a $200,000 house, I would ballpark high level, again, $24,000. You can ask the seller to pay 3% of the sales price, so it'll be up to $6,000 toward your closing costs. The way you can do that where everybody's happy is you're essentially financing your costs. Just raise the price from 200 to 206. Go back to the seller, say, look, I'll pay you 206. You pay $6,000 in my closing costs, and the seller still gets the 200, and then you eliminated $6,000 in cash that you need. It's called Seller Assist. Our programs, we got 2 programs that can help you save thousands of dollars if you hire us to help you buy a house. So we'll pay, again, on traditional commission-based model. A lot of folks really don't understand how the multi-list works. They're usually 2 agents. Sometimes they work for the same company, sometimes they work for different companies, but there's a listing agent and a selling agent. The seller typically pays the commission. So if you do the traditional commission-based model, the seller pays us, and what we'll do is we'll start paying closing costs for you at a $200,000 value. We'll pay $2,000 of your closing costs at $200,000, and as it goes up to $300,000, $400,000, $500,000, $600,000, we pay more all the way up to $5,500 of your closing costs. And so it's a great program. I don't think you'll find that with any other real estate broker in the area. That's the traditional commission-based model that everybody's familiar with. But we offer programs where you can pay by the hour, and if you're efficient in the use of your time, and you kind of know what you want, and you can focus on an area and educate yourself with our help, and really narrow down what you're looking for. You pay us by the hour, and then we give you the seller side, the buyer side commission. So if you're on a $500,000 house, if it's a 5% commission, that's $25,000 the seller's going to pay. The buyer side is $12,500. On our hourly rate program, which is $85 to $95 an hour, minimum of $1,500, you pay us to help you find the house, negotiate the contract, help you through the process, and you may pay us. If you're efficient with your time, it's not beyond reason to think that you might pay $2,500, and if the commission is 12.5, you could actually get $10,000 back to pay toward your closing costs. So it's a great program. It's a different model. Again, it's an option we have. It's the hourly rate model. So if you want, give us a call or email us, and we'll give you more information about that. So qualifying for mortgages, high level, you can have 43% of your monthly income in debt for a conventional loan, a little more for an FHA, and same thing for the BA. They're a little easier to qualify. They've got expanded ratios, and the FHA and BA, and they'll take some ding to credit. But if you're getting a conventional mortgage and you say make $10,000 a month, $120,000 a year, you could have $4,300 a month in debt, and that includes the new mortgage. So again, what we can do is, if you give us your income, we can work backwards actually and figure out how much, take your income, take 43%, start subtracting your monthly debts, and come up with what's left for a payment. How do we get that? How do we determine your income? Base salary is easy, but if you've got income that's variable, like overtime, part-time, bonus, commissions, you need a 2-year history with the same employer, and then we have to average it, and it shouldn't be declining. That's an issue. If your income, this variable income, has been going down, it's harder to use that, and we have to be very conservative and maybe use the lowest amount of the average. If you get alimony and child support and you've received it for at least 6 months and it's going to continue for 3 years, we can use that. Now, as far as debts, child support is always a debt. Alimony, when we qualify people, we can actually look at it and see if we just deduct it from your income, if that helps you qualify more than counting it as a debt. But you can use it as income as long as you've received it for 6 months. It'll continue for 3 years. An IRA, if you just started drawing on an IRA, if there's enough money in there to continue for at least 3 years based on what you drew, you can use that income. If you are about to start a job and you want to close before you start the job, that can be problematic. We need an unconditional contract, and we'll need to get a pay stub. But if you can, that comes into play more with people that are getting relocated and they want to close in the house before they start their job. It doesn't come up very often, but if you're going to do that, again, talk to us so we make sure that we tell you all the details about the documentation. The big one is an unconditional contract. Can't be conditioned upon anything. What are debts? What counts? We tell people, we ask people what their debts are, and they give us things that sometimes we don't have to count, and then sometimes they forget things that we do have to count. Car loans or leases count, whatever the payment is. Minimum payments on credit cards. If you're going to buy before you sell, your current house payment counts as a debt, including real estate taxes, insurance, flood insurance, and homeowner association dues. Even if they're not included in the payment, we have to get that information, and those all count as debt. Student loans, even if they're deferred, we have to count a payment. So we either have to get an estimated payment, or we can use 1% of the balance, but that can be a big number. So if you have $100,000, that's $1,000 a month payment we have to count. Income-based repayment loans are usually greatly reduced, and you can do that on a conventional loan. FHA won't let you use income-based repayments to qualify. Again, if you pay alimony or child support, that's a debt. That counts. Loans that come directly out of your pay, not loans against retirement accounts, not a loan against 401k, but loans that may come directly out of your pay that aren't for savings would count as that. Things that don't count, typically utilities, cell phones, gym memberships, car and health insurance. You pay those monthly, but they're not counted as debts when you're qualifying for a mortgage. So let's suppose we run the ratio and you're not qualifying. We can do, here's 2 quick strategies. One, if you've got a debt that's got a kind of a high payment, like a $500 a month payment, but you only owe $2,000 on it, it could make sense for us to use some of your cash to pay off the debt, and then just put down less money whenever you for buying the house. Again, it comes into play If you've got, and well, you can combine the strategy with maybe bumping up the price now, and the seller pay 3% of the sales price, so that you can free up some money. We never tell people to pay off the debt until closing. We pay it off at closing in case something happens and the deal doesn't close for any particular reason. If we have two buyers, there's number two, and one may have a credit issue or too much debt or not enough income, uh, we can, especially if it's a married couple, we can just use one of the, the husband or the wife, and for the mortgage, both of them can be on the deed, but we only use one to qualify. If you're not married, it can be problematic because if you break up and you want to take yourself off the deed, or you want to, one of you wants to buy the other, not, you're going to have transfer tax, which can be expensive. Again, half the value of the house, up to 5%. So you got to be very careful if you're trying to buy a house with somebody that you're not married to. If it doesn't work out, it can be expensive to remove one person from the deed. The example I have here is the husband has lots of debts and not great credit, but the wife qualifies on her own. Put the mortgage in the wife's name, and both husband and the wife were on the deed. So those are two quick strategies on how to structure the transaction. Now we're going to talk about mom and dad helping a child to buy a house. So in this situation, suppose mom and dad gift the child $20,000 to buy a new home. If mom or dad has a stroke and they need to go into a nursing home within 5 years, the government says, well, you could have used that money to pay for yourself in the nursing home, so we're not going to pay the first $20,000 of your care. If the child has the money and can repay you, that avoids the penalty. But that's again, that's one situation where mom and dad are giving cash to help a child buy a house from a third party. Now, let's suppose mom and dad have a house or a property that they own that's worth, say, $200,000, and they agree to sell the child the home, and they're happy with 150, so they give the child a gift of equity in the house of, say, $50,000, which is 20% plus closing costs. So the child gets in the house with no money. They don't need any money. But if mom or dad needs to go into a nursing home in the next 5 years, again, the government won't pay for the nursing home until mom and dad have paid $50,000, because they had $50,000 of equity. They gave it away. It's a transfer for less than fair consideration. And the Medicaid, the government says, well, you could have paid for your own care. So until you pay $50,000 out of your own pocket, we're not going to pay. Again, these are pitfalls involved with mom and dad giving money or equity to a child. Now, let's suppose they co-sign, mom or dad co-signs because the child doesn't qualify on their own. The best thing to do is try and get mom and dad off the property, off the deed, because they've got to be on the deed and the mortgage. So try and get them off the property before, well, as soon as possible. Because again, if they need to go into a nursing home and they want the government to pay, you're going to have to show that they didn't contribute to the property, and it's a problem. It's something the government may say, "Now you have equity in that house, and so we're going to count that as a debt." It could be labeled as an unavailable asset, but it's a problem. You really don't want to keep them on there. And also, let's suppose you do keep them on there, and mom or dad passes away, you're going to wind up having to pay inheritance tax 4.5% on half of the equity in the house. So if mom or dad co-signs, that's great, but the idea should be that it's going to be for a short period of time. You're going to remove them to avoid these other potential issues for mom and dad. Plus, it could be an issue for mom and dad qualifying for other loans if they got your mortgage in their name. I think this is one last example. If mom or dad, they sell their home, they get, say, $100,000, and they move in with the child, and they give the child $100,000 to put an addition on the house to make it big enough for mom and dad to live in, and the child gives mom and dad a life estate in the property. They've got to live there for at least a year, or the government's going to consider the $100,000 as a gift, and they're going to count it, so they'd have to pay for the first $100,000 of their care. And 4 different examples of real estate and mom or dad trying to help a child either buy a house or the mom or dad moves into the house with the child, but it's not big enough, so they're going to try to make it do an addition, make it big enough, and that could be a problem if they need care within the next year. What kind of paperwork do you need for a mortgage? This is not all inclusive, but this gives you a pretty good idea. You need income information, asset information, and some other contact information. So most recent 30 days of pay stubs, an email or fax number for the person in human resources or payroll. We need to get a form filled out typically with the start date, the position, probability of continued employment, 2 years tax returns with the W-2s, only the federal, not the state tax returns, all schedules. We don't need the worksheets, but all schedules. Most recent 2 months of bank type statements. So wherever the money's going to come from, if it's a checking account or savings account, we need the most recent 2 months, all pages. And if you're moving money around, we need to source all the money. So if you're moving money from one account to another account, we're going to need 2 months of statements on each account. Agreement of sale, that for a purchase, it has to be signed by everybody. Sometimes we get them signed just by the buyer or just by the seller. Copy the front and back of the cashed hand money check. And we'll have to get a history that shows cleared. So you're going to give a deposit check to the seller to buy the house. We're going to have to get a copy of that check after it's cashed, and then we're going to have to get something from the bank that's like a mini statement that's called a history that shows that money cleared and what the new balance is. We'll need your homeowner's insurance agent to contact us for the mortgagee clause. We'll need a credit card to pay for an appraisal. If we need an appraisal, sometimes we get appraisal waivers. And depending on what you do, we may need you to go to irs.gov and print out the IRS transcripts to show that the tax returns you gave us are the same tax returns that you gave the IRS. It used to be a bigger problem, but because people would have 2 sets of returns, one for the banks, one for the government, especially self-employed people. We don't run into that very much, but again, depending on what you do, especially if you're self-employed, we're going to need transcripts. Self-employed people, in addition to what we just went through, we need business returns. So if you got a partnership or a sub-S corporation, we're going to need those tax returns for the last 2 years, IRS transcripts on those tax returns. And during COVID, we had to get a profit and loss statement year to date, and the last 3 months business bank statements verifying the income and expenses on that. That has since gone away, but if it resurges, well, self-employed people should be aware that you could need some additional documentation like a year-to-date profit and loss. What are interest rates doing? They're moving up right now. They're in the mid-5s with no points, but about $1,400 in bank costs. And people ask me what the APR is, and most folks don't know what an APR is. Somebody told them you should ask. And as long as you understand that the APR is going to vary with the loan size. The APR, what it does is takes the interest rate on the loan and it adds the closing costs factored into the length of the loan. So it amortizes it over the length of the loan. So if you have a $100,000 loan and you have a 5% interest rate and $1,400 in closing costs, your APR is going to be higher than if you get a $300,000 loan, because the $1,400 is spread over a higher loan amount. So I always, we can give you the APRs, but you really want to know what's the rate. Is it fixed? Make sure there's no negative amortization. It's fully amortized loan. And what are the bank costs, not the title insurance, not the transfer tax, but what's going to the bank, underwriting fees, administrative fees, processing fees, if you're going to compare different companies. And ARMs, again, aren't bad. If you have a fixed income with no room for increases, you really probably don't want an ARM. But if you have a job where you're going to make more money in the future, ARMs aren't necessarily a bad idea. It's, how much interest are you going to pay, especially if you think you're going to move in 5, 6, 7 years. An ARM might be something to consider. If you're going to move in a shorter period of time, the question is, why are you buying the house? Because you're going through closing costs when you buy, and then when you sell, it's really hard unless you've got a relocation package and maybe an employer's paying for it. What do you need to know about ARMs if you're going to get an ARM? Adjustable rate. Well, here I'll give you an example. We have a 6-month ARM, and it changes every 6. It can change every 6 months. It starts at 2.5, It's got a 5% cap. So the worst it can get is 7.5% ever. So that's what I'm saying. It's not, these things aren't so dangerous that it can go up to, double digits. This particular arm change every 6 months, but it can only change by 1%. So you start at 2.5, it's a teaser, right? And it can go up to 3.5 in 6 months and 4.5 in a year. How do you determine what it goes to? Well, because those are caps, so that's the most it can change. To determine what it can change to, you add two numbers, the index and the margin. The index for this particular arm is the secure overnight financing rate. And that's right around 0.78% right now. And you add that number to the margin, and that rounded to the nearest eighth is going to be the rounded up to the nearest eighth is going to be the new interest rate. So if you wanted to say, well, if there were no caps, what would my rate be? It would be a little under 3.75. And again, not really bad, and much better than the fixed rates. And if you put down a chunk of money, if you've got money available, when it adjusts based on the outstanding balance. So you can actually, if you've got some cash available, you could control how much interest you pay. Just again, a thought, just so you have some information about how ARMs work. How long does it take to close? We're still closing conventional loans in 30 days or less. It's, and sometimes 3 weeks if we don't need an appraisal. Again, we get the property appraisal waivers pretty often. FHA and VA loans a little longer. VA definitely I plan for 60 days because you got the VA that does the appraisal, and once you get the appraisal, then you can have issues, and you have to deal with the issues on peeling paint or safety violations, safety concerns. And then the appraiser's got to go back out and take pictures and write a report. So I would figure just more because of the appraisal process, a little longer on FHAs and VAs. Closing. So now you're all done. You're approved. You close. What happens there? It's not a big deal. I mean, it's kind of archaic because in Pennsylvania we still actually meet in person. Not that you have to. I for sellers I represent, I often have the paper signed in advance. I go to closing for them if we need to have somebody go and take keys and garage door openers and things like that. All the numbers should be done at least 3 business days in advance, so there should be no surprises. If you're a buyer, you need to get a certified check, or you have to wire money. If you're going to wire money, before you do that, you double check and triple check to make sure that you've got the right wiring instructions, because one of the biggest problems in closings and fraud is wire fraud, where somebody gives you information of where to wire the money and it's not the right place. So just keep that in mind. Again, usually it's pretty informal and there shouldn't be any issues at closing because all the numbers are worked out at least 3 days in advance. And if you've got any questions, feel free to give me a call or send me an email. Visit my website, keithelliu.com. My email is keith@keithelliu.com. My phone number is there, 412-921-7100. Stop sharing this. So that was the presentation. Again, pretty short. We wanted to give you the message that give you an idea of what you're going to encounter when you're thinking about buying a house and financing the house, and in particular that we can save you thousands of dollars. So if you're looking for a house, you want to call us and ask us about these programs. It will help you reduce your closing costs greatly. So thank you again for watching. We hope to hear from you. By the way, we have these webinars every Saturday morning at 9 o'clock, except for the Saturdays that we're on the air on KDKA, and that shows at 8 a.m. once a month. Thanks again.